Hi, everyone. We are live. I am Debbie Schwartz, founder of Road to College and the Paying for College 101 Facebook group. I'm here tonight with Angela Colatriano. She's Chief Marketing Officer at College Ave Student Loans. So we're going to talk a lot about, the basics of student loans, but I want to give everybody just a few minutes because I know you're just being notified that we're going live. There were a lot of notifications on the page in the group through email. So as soon as you come in, if you want to just say hello, tell us where you're coming from, how many kids you have, feel free. And always feel free to ask any questions in the comments. We may not answer them exactly when you type them in, but I'll be scrolling through. I'll try and fit them into the conversation, and then always I'll go back to the end and see what we've missed. So how about Angela, if you don't mind, you want to just give us a little bit of background on yourself, on College Ave Student Loans? I think people would love to hear more about that.
Sure, I'd be happy to. Well, I'll say first for myself that I've spent over 15 years in financial services in various categories of financial services, but I spent the last 10 in student loans. And I do feel very strongly about it. I'm really happy to be able to help people achieve their goals and invest in themselves and in an education that's going to help them for the rest of their lives. And I can tell you that the rest of the folks at College Ave Student Loans, it's really why we started the company. It was started by a group of industry veterans who just really wanted to feel like we were helping to take some of the stress out of paying for college. And I would say the main ways we do that, we try to give people great options, and we try to give them great tools that show them what their choices are, so that they can be really confident in the choice that they make and ultimately find a loan that will help them achieve their goals and also fit into their life, so fit their budget and work for them.
And so you were even telling me earlier, how I think some people may be familiar with College Ave Student Loans. If you are new to student loans, if this is your first child going to college, you may not be familiar with the name. And really, you've only been around for, you mentioned 5 years, which isn't that long.
Mm-hmm, that's right. So we are solely a private student loan provider for anybody who is very new to the process and you're sort of sorting out the federal versus private. I know we're going to get into that in a little while. But College Ave Student Loans is a private loan provider. And we focus a lot on really undergraduates. We do also do loans for graduates, and we also do loans for parents. But I would say the majority of what we do is really to support undergraduate students who are going to get their first degree.
That's great. And I would imagine that's a lot of people who are going to be listening tonight. I see a lot of people who've said hello. Heather from Palm Harbor, Florida. Tracy from Illinois. So anybody, as you come on, say hello. We'd love to hear, where you're from, how many kids you have, where you're in the process. Again, my gut is that most people who are going to be listening tonight, you are new to the process, which is completely fine. That's why we do these Facebook Lives. Most people, their student has just accepted, right? The May 1st. And I'll tell you, I know the feeling, it takes a long time to get to May 1st. You've gone through a lot of steps to get to that decision. And then you take a little breath and then you sit back and you're like, wow, now I got to figure out this financing stuff. Now I got to figure out these loans. And unfortunately, you may not realize it, but this is kind of like another phase of the process. Mm-hmm. It won't last as long, but you got to continue to do your research. You got to continue to, gather your information. And, as you get past this stage, then everybody's in college and they're off and running.
Mm-hmm. We recognize that people are exhausted, frankly, by the time they get to the point where we come in, which is why we really try to offer tools so that we can try to make it clear, because we know that they've been through college applications and award letters and the FAFSA usually and all of these other pieces before they get to us.
Yeah, that is exactly the perfect way of saying they're exhausted. And I don't think a lot of people even realize they're like, wow, I got to figure this out now. They thought it would. I don't mean to say it's complicated, but it is another step. And, unfortunately, every step in this process is not the easiest. Not that this is hard, but it's kind of, it is, you're almost at the finish line.
And you don't do it very often. You may have dealt with it when you went to school, and then you forget about it for 20 years. And then you come back into the process again, and you have to relearn anything that's changed or sort of start again. So it's definitely, we get it. It can be confusing. It can be, and again, you've been through so much at that point when you get there. It can feel overwhelming, but it doesn't need to.
Right. Great. Okay. Well, lots of people. It's great to see everybody. Lynn has a high school senior graduate Saturday. Congratulations. That's also around this time too. A lot of people, fun, great stuff. They're dealing with graduation. But again, I know as a parent, May is a lot going on. So Tina's from Massachusetts, Tara from New Jersey. Good, great. Okay, again, as you come and start watching, feel free, tell us where you're from. Love hearing it. Love to hear, what your family situation is. Ask questions, and I think we're going to get started. Again, tonight is really kind of it is the basics of student loans. It's just to kind of orient everybody to what they need to know. I doubt, unless you've gone through this before, maybe some of this will be repeat information. But if you've never been through it, then this is all going to be somewhat new. You might have heard it along the way, but now's the time you really need to know it and use it. So we're kind of going to start from the beginning, and we're going to talk about federal loans and private loans and just all the basics that you need to know as you start the process of gathering information and ultimately leading to a decision. So with that, Angela, why don't you just start and tell us the different categories of loans, the different federal loans, the different private loans, and any borrowing limits that might be connected to those types of loans.
Sure. So I'm going to start with the most common. Usually what we always encourage people to do is start with the FAFSA. And what the FAFSA is going to give you access to is the federal loans that will be available to you.
And so, I don't mean to but that is so important.
It is.
People don't realize that, especially people who, families who say, well, I know I'm not going to get financial aid. You might not get financial aid, but you're not going to get access to any federal loans unless you fill out FAFSA. And the most important federal loan is the student direct loan. So anyhow, I'll take it from you, but I just wanted to emphasize that. You take it.
I'm actually going to jump in there too and just say we encourage everybody to do it, not just because you can access the loans, but some schools actually use it to decide whether or not they're going to consider you for merit aid.
Yeah,
they can actually use whether or not you completed the FAFSA to consider you for any aid, and you certainly don't want to miss out on merit aid. So the FAFSA is always the place to start. And then from there, the most common type of federal loan is going to be the unsubsidized direct loan for undergraduate students. And that has different limits by year and then a total limit of what you can borrow. So typically your first year, you can borrow up to $5,500. And the up to, when I mention it, is really dependent on what does the school cost. So, what have they already given you maybe in scholarships or grants, and et cetera? And what do you have left that you need to cover? And that's what would dictate how much of that $5,500 you could access. So then in your second year, you can typically access $6,500. And then from the third year forward, you can access $7,500 a year. And the maximum limit is a little over $31,000. I think it's $31,500 that you could borrow over the life of your education in order to fund your education in the unsubsidized loans. So then you have the subsidized direct loans for undergraduates. The difference between these two is that with a subsidized loan, the government is actually covering the interest while the student is in school. With an unsubsidized loan, which is again the most common one, the interest is actually accruing while the student is in school. So the interest is getting charged from day one, and all of that interest is going to need to be paid back. With the subsidized loan, the government is covering that interest during the in-school period. So you're not being charged interest until the student leaves school and gets out of their grace period.
And whose name are these loans in?
Both of those type of loans are completely in the student's name. So the parent is not on the loan for either one of those. And they are, typically the lowest interest rates you're going to find. The interest rate is, I believe, about 4.5% next year is what's been published. I will tell you the Department of Ed website has not been updated yet, but it is in the process of being updated, and it's supposed to be coming down to about 4.5%. There is also a little over a 1% fee that will apply to those. The fee will actually be added to the loan amount, and you'll pay the fee back as a portion. You'll pay the fee back as you repay the loan.
Okay. So, and I think nobody would really argue, I mean, across the board in the industry, if you need any money, your student should take the federal subsidized or unsubsidized loan first. It's going to be the lowest, interest rate loan that they can get.
Yes. Yes. And then it does have certain repayment protections that come along with it as well. So that is really always going to be your best starting point. And then from there, you just have to determine, does that cover everything you need? Because as I mentioned, there are going to be limits on that. So let's just take a freshman as an example. If you need more than $5,500 in order to cover the costs that are left after, again, you take out any scholarships, grants, anything else that was awarded by the school, then that's where you start to evaluate some of your other options. And the next option to you as a parent of a freshman, again, let's just take that scenario since it's probably the most relevant for folks here. What you would then have at your disposal through the federal program would be the Parent Plus loan. And the Parent Plus loan is at a higher interest rate. So it will be, I think, just above 7% for next year. And it has about a 4% fee, a little over a 4% fee that is attached to the Parent Plus loan. There's really no limit other than the cost of attendance. So as long as you have costs associated with the school that the school would say are part of your cost of attendance, room and board, technology, they allow some costs for travel, that type of thing, then you would be able to take a plus loan up to that remaining amount. The important thing I think to consider once you get to that stage where you're maybe considering a plus loan, that's where you really want to start to ask some questions in terms of, can you as a parent take that on, or do you need to share responsibility for the loan with the student? And what interest rate, what does your credit look like? And what interest rate might you qualify for in the private loan side? So that's where you want to start. If you're thinking about plus loans, that's where you probably want to also start to think about, what does a private loan look like and how do I compare these two options? Because for a few different reasons, private might be a better option for you if you're considering plus, if you're in that category where the direct loan didn't cover all of your costs.
I'm just going to backtrack 1 second because Lori asked, and I think she's referring to the first conversation about the federal direct student loans. She asked, is the interest rate the same for everyone? So maybe you can address that, is the interest rate the same for everyone for the Parent Plus loan, and then obviously for private loans?
Sure. So with the direct loans, the interest rate is the same for all undergraduates, and then there is a separate interest rate for graduate students. And the rate for graduate students is actually a little bit higher. I want to say it's going to be just over 6% next year for graduate students who take the direct loan.
But so any undergraduate,
yes,
regardless of, whether you're getting scholarships, financial aid, merit scholarships, regardless of what your family income is, really, everybody gets the same interest rate.
That's right. And the unsubsidized loan is really not based on, the government would tell you it's not based on financial need. So it's really just dependent on, are you going to a school that's eligible, which is, really your degree granting institutions that are out there. Is your student enrolled at least half time? And do you have a piece of the cost of the school that is not being covered by grant scholarships, et cetera? But for the unsubsidized loans, they're not considering, well, how much income do you make? They're not factoring those pieces in. So to your point, they're available to the vast majority of people, and they're all going to be at the same interest rate.
Right. And then Parent Plus loans. Explain the same thing, related for.
So Parent Plus loans, again, those are all going to be at the same interest rate. So there's not going to be a difference in the interest rate that you get. From an eligibility perspective, there are a few different credit requirements on that don't apply to the direct loans. So there are some basic credit attributes that they are going to be looking for. So they will evaluate, have you had a recent bankruptcy? Have you ever defaulted on a federal loan? It's usually a shorter list than what you may have to go through to qualify for a private loan, but there are still some constraints on that you wouldn't find on the direct loan that's going to the student.
And Adrienne has a great question. She's asking, if you don't use the federal loans year one, is that money available later on?
So I'm going to say yes and no. So here's the trick with that. You can always borrow, like I said, up to $31,500. So but they are going to limit what you can borrow each year. So if you don't use it year one, it doesn't mean that you can add that up and take out double sophomore year. Sophomore year, you're still going to be limited to the $6,500 that is available to year two students. But what I will tell you is that if you don't use it that year, and then you use your $6,500 sophomore year and maybe $7,500 junior year and senior year, you would still have access to that money, say for your first year in graduate school or your second year in graduate school. Again, you're going to be limited to you're only going to be able to take it out in $7,500 increments for each of those years, but you would be able to access it for graduate school. So I think it's important, as you are sort of thinking about that, how and when do I take it, to try to think about what is the long term. Do I see myself going for just an undergraduate degree, or do I think I'm going to be going to graduate school?
And what about, I hope not, but if somebody goes for a fifth year of school and they still have, and maybe they didn't take the loan one of the years, can they use what they have remaining in the $31,500 to
That's
use
right.
fifth year?
Yes, that's right.
Okay. And Claire has a very good question. I don't know. And she's asking, why would a college only offer unsubsidized loan to a student and they wouldn't offer a subsidized loan? So like, who makes that decision between subsidized versus unsubsidized?
So the unsubsidized versus subsidized is it's going to be communicated to you by the school, but it is somewhat dictated by guidelines that they have from the federal government, because it is a federal loan. And the subsidized loan, where they're covering your interest during college, is what they would say is based on your financial need. So what they're considering there to decide whether you can qualify for a subsidized loan is your expected family contribution. And they're trying to basically direct the subsidized funds to the students that have the most need based on their expected family contribution.
And, I would say to people, if you have a question, ask the school,
Absolutely. The financial aid office is an incredible resource. They are experts in these cases. And I would also encourage everyone to check out the studentaid.ed.gov website. There really is a wealth of information on there about all of these federal programs. And I think they've made dramatic improvements over the last several years, that it really is fairly user-friendly. Don't get me wrong, there's a lot of information, but it's good information, and the answers are there. So I think the federal aid website and the financial aid office are both fantastic tools to make sure you understand what you're considering and you can weigh them all appropriately.
Right. I hope that people feel empowered, meaning, don't feel you're making a decision and you don't understand something. You always ask questions. You shouldn't ever, feel forced that you need to do something without truly understanding it.
Yes. If you don't understand what you're signing on for, then you definitely need to pause, because the answers are out there. Right. And you shouldn't go into something feeling like, I'm not sure what I just did. I'm not sure what I just signed up for.
Exactly. Mm-hmm. Okay. Edie has a question about the Parent Plus loan, and she's asking, is there a minimum or a maximum credit score requirement? I mean, you mentioned a little bit about credit, but are they really actually looking at your credit score for that loan?
No, that's so usually on the private side is a little bit more when you get into credit scores. On the Parent Plus side, they're really just looking for some of those very specific items. They're, bankruptcy, prior student loan default. They're not really considering a credit score per se.
Okay. So let's kind of move on a little bit. There's definitely more questions, and I'm going to come back to them. So you started talking about, we've discussed students should take out the federal direct loans, whether they're subsidized or unsubsidized. That's kind of like a given. And then you're into the next territory. If you need to still borrow money, you really have to now look at the Parent Plus loan versus private loans. So what advice would you give people? Like, how should they start making the decision about, should they consider a private loan? Should they stick with the Parent Plus loan? What should they be thinking to themselves?
Sure. I think fundamentally you really have to start as a parent. You have to really ask yourself the question of, can I take on this debt? Because if you're taking on a plus loan, you are the only one that is technically responsible for that loan. You can potentially try to make a side agreement with your child about who's going to pay it, but at the end of the day, it's going on your credit report. You are the one that is taking on that loan and that responsibility. So I think that's kind of the first fundamental question that you have to be honest with yourself about, and maybe talk to a planner, talk to people that can help you with advice if you're not comfortable with that and confident that that's a good choice for you. And then I think once you've sorted that out, because if you really are not comfortable completely taking on that debt and being 100% responsible for that debt, that is one reason why we see people shop in the private market. Because in many instances, undergraduates, they might need a cosigner. So they may need somebody to sign on to also share the responsibility with them. But then your student is also legally on the loan. So the student is sharing the responsibility with you. You're certainly not completely off the hook, but at least you're sharing it. And it can be easier to refinance that debt down the line as well into the student's name if the student is already on the loan. So I think you really have to think about end game. Can you be the one responsible for it? Or do you really want to set it up front that you're sharing it? I think that's a good initial conversation. And then beyond that, it makes sense to consider, what is your credit? So what kind of rate might you qualify for in the private market versus the Parent Plus loan and the rates you're going to get on the Parent Plus loan? And, I encourage you, shop around. We have a pre-qualification tool, so parents can actually pre-qualify and see what might they qualify for if they co-sign a loan, what might they qualify for if they take a private parent loan, because that's a third option we can talk about. And then they can compare those to what they see on the plus side.
So can we stop there for 1 second about pre-qualification? Mm-hmm. This is a question that comes up all the time. In fact, it came up today. Mm-hmm. Somebody said, I'm so afraid I'm going to apply for the loans. I'm going to be denied. And then my credit's going to be, I'm going to get, this is going to be horrible for my credit. Mm-hmm. So how does pre-qualification help with that?
So pre-qualification actually doesn't affect your credit score at all. It is what they call a soft hit, if anybody's familiar with that language. But essentially, it doesn't count against your credit. It's not going to hurt you to pre-qualify. There's really no reason not to pre-qualify. Now, I will say it's not a full application, so it's not a guarantee, but it's a great first step to get a sense of, is this loan going to be right for me, and what rates might I expect if I do decide to complete a full application? I think the next piece that's important to keep in mind is, if you do decide I'm going to apply and I'm going to shop and apply real applications, not just pre-qualification, but real applications within a 30-day window.
Yeah.
Because the credit bureaus expect that type of shopping behavior. And when they see you applying for the same type of product, whether it's a mortgage, an automobile, or a student loan, then they understand that behavior, and it will not affect your credit score in as negative of a way as if they saw you doing it, kind of every single month for a year, let's say. They understand that shopping behavior when it's contained within 30 days and they've solved for it.
And this is so important because, again, like the question that I see a lot is, where's the best place to get a loan? Or where did you, what was the loan where did you get your loan from? And you can't make a decision like that in this process. You have to get the information for your situation. Mm-hmm. And so either going to a lender that's going to pre-qualify you and get the information ahead of time, or you should feel comfortable that, as you said, Angela, if you actually do real applications and you do it within a 4-week time period, you're not going to get dinged by the credit bureaus. Mm-hmm. I mean, it's your chance to gather the information that you need to make a good decision.
That's right. That's absolutely right. So I think it's being thoughtful and it's planning. But I would just echo what you said there, that this is a tough one. I mean, it's great to get people's experiences if they have feedback about how they felt the customer service was, or maybe whether or not it was easy to use. But in terms of what you can actually expect for your interest rate, it's really such a personal thing that's a difficult aspect of the loan to just get from somebody else.
Right. Okay. Okay, so you've touched on it, but why don't you talk a little bit more about the private parent loan and why somebody may or may not consider that compared to, the other two options that you've talked about?
Yes. So the private parent loan it's going to be, I'm going to call it relatively similar to the PLUS loan because it's only the parent that is taking responsibility. The student's name is not on the loan. So we typically look at it again as you have to fundamentally first make that decision that you want to be the one paying. And so that's kind of first and foremost who might want to consider the private parent loan. And then the next piece of it is that you can sometimes get better rates in the private market than the Parent Plus loan. So if you've made that decision, you want to pay for college, you just need to spread the payments out. You may actually find that if you've got strong credit, you might be able to get a better deal in the private market than you get on the Plus side. Mm-hmm. So those are typically the scenarios we see.
And just so people know, not every lender offers a private parent loan. So, College Ave is one of just a few that do.
That's right.
So, you may not see it a lot for that reason, but it's, again, it could be part of your consideration set when you're kind of thinking about the different loan options that, your family might want to do.
Mm-hmm. Absolutely.
Okay. I know that there's a ton of questions here and we're going to get to them, but I think we might answer some of the questions as we continue talking. So, just talk a little bit about timing. So people also get very anxious. Oh my God, how long is it going to take for me to get approved? Should I do it now? Do I need to wait? What's the whole, when should they start to get worried? Not that they really should ever get worried, but when should they really, make sure that they're getting their,
right.
ducks in order?
Right. I mean, look, definitely you take a student loan to pay a bill, right? So the very first place that I would start is, now that your students have probably selected their schools and they know where they're going, go to the website or look at the materials the school has sent you and understand what they're billing. When are they going to send you a bill? And when is the bill going to be due? Because you're going to want to basically back your timeline off from there. And what we tend to see is that the bills often go out in July, but it's often after July 4th. So it might not be until the middle of July that the bill arrives. And it could actually be due in early August. Right. So that's why I encourage everybody, get familiar with what that timeline is going to be, because if you wait until you get the bill to start some of these other pieces I'll talk about in a second, you may just find that you have a very tight window there and you may start to feel that pressure that you really don't want because you don't want to make a decision you're not comfortable with. So the first thing I would do is figure out what that school timeline is. Then we would encourage folks, maybe 90 days before you expect that bill to be due, which let's say we're getting roughly into that right now. I think that's when you really want to do your research on how much do I think I'm going to need to borrow. So, start doing your calculations around, are you in state or out of state? How many times is the kid going to want to come home during the year? Mm-hmm. Are they living on campus or off campus? Are you paying for, maybe a major where they have, books where they have, special requirements or lab fees or things to that effect. Get a sense maybe from people who are already in college of what are they spending to either go out, enjoy things on the weekends. Like what's a reasonable budget for other kids who are going to that school? Because it really can depend on where the school's located, exactly what the right amount is for those things. But that's basically what you want to start to lay out is what are all of those extra costs? And then what am I expecting to need to cover from a tuition and fees perspective? And that will help you start to circle on what's the number I'm going to need to borrow, what loan amount am I going to need? And that's also where you want to figure out if you are considering a private student loan, who is going to be able to co-sign the loan with the student? Because most private loans for traditional undergraduate students, because they just don't have an established credit history or income, most of those loans are going to need a co-signer. So, if you have mom and dad and you maybe want to figure out who is likely to have the best credit, who's going to get the best interest rate, who's going to be the one to actually take the loan with the student. So about 90 days before, I think, is when you want to start really doing that homework. And then, about 60 days before, maybe 60 to 30 days, I would say, is when you want to start shopping around a little bit. That's where you want to pre-qualify, get a sense of what rates people are offering, narrow it down to who you think you want to go with. And then no more than 30 days, I would recommend applying for the loan. No more than 30 days before you think the bill is going to be due. And I'll tell you why. So we have an extremely fast application process. I can tell you in 3 minutes if you are approved for the loan or not. But part of the student loan process is that we actually need to communicate with the school. So after we say you're approved, we need to communicate to the school that you've requested a loan and what loan amount you requested so that they can verify that you actually have that need, that you've not already met your cost of attendance through, again, scholarships, grants, the federal loan, any of those things. And that communication loop can take time, particularly when you get into July and August and schools have many of these requests coming in. So that's why you don't want to get too close to the date. You want to try to make sure you're applying at least 30 days out so that you allow time for that back and forth communication that needs to happen between the lender and the school.
So once somebody gets approved, should they feel comfortable that the lender is taking care of those communications back and forth?
Yes, absolutely. So that's really, it's a component of being in this business. I would encourage you, you want to keep tabs on it. We send at least weekly communications, sometimes more frequently depending on the situation, but at least weekly communications to keep people alerted to where the loan is in the process, whether or not we've heard back from the school, whether or not it's reached a point where maybe they need to reach out to the school because we're not getting an answer. So we actively communicate with anyone who's in our process, but I would encourage people, stay on top of it, make sure you know where it is, because you do have to allow for that back and forth time and then ultimately for the money to be able to get to the school by the due date. And
I would hope that when you say communicate, it's some communications are being sent, I assume, to the student and the cosigner.
That's absolutely right. So it's usually, it's always student and cosigner. Email is one of the primary ways that we communicate, which seems to be very popular with everyone. We do offer texting options as well. So we try to offer a variety of options. We found that email tends to be the most popular. But yes, we're absolutely communicating with everybody who's engaged in the process.
I only say that I'm pretty sure I feel comfortable that parents are, checking their emails, but students may not. And especially, I feel like that time that transition, they may have a personal email. They may have had a high school email that they've, not using. They may be starting to get a college email, So anyhow, I wouldn't just leave it up to the student to make sure that they see all the communications.
I think that's very good advice.
Okay. And now, let's say we've gone through, we've gotten approved. The lender has had the communications back and forth with the school. The amount's been verified. Mm-hmm. How is it distributed? Mm-hmm. Especially if you might have been approved for a full year, but, the first bill is not covering the full year.
That is a great question. So that is a very common scenario that we see, especially in this July and August window. We will see people apply to cover the fall semester and the spring semester, which you can absolutely do. You can cover up to a full academic year. And we will go through that process with the school to certify the loan. That's the sort of the communication I was talking about. And during that process, what the school will do is they'll come back to us and say, okay, yes, let's just say $5,000, just as an example. Yes, the student needs $5,000 and we want $2,500 of it for fall and we want $2,500 of it for spring. And the school will actually tell us when they want us to send the money and how they want us to send the money. And then we will distribute the money to the school on the schedule that they've given us by the method that they've given us. So it's usually electronic, but there are some other, there's some nuances to that, let's say. But for the school essentially dictates when do we send it to them and how do we send it to them. And if you've borrowed for more than you owe in tuition and fees, so let's say you've borrowed, let's say they're living off campus. That's a great example where you can certainly borrow for living expenses for off campus, but you're not paying that directly to the school. They will refund that money to the student, that overage to the student. And again, they decide how to do that. So that's a great thing to understand up front. How will the school do it? What are their processes and how quickly can you expect them to do it? Because they may put it on the student's, the student card. They may send you a check. They may give you a preloaded Visa card, but it is very school by school. So I would highly recommend if you're borrowing for more than tuition and fees to know up front what their processes are.
That's actually a really good point, to know how they're going to give the money back. And as you said, the timing, because, you might have borrowed more because you need that for other expenses. And
exactly.
You need to know the timing on which you're going to get it.
Yes. That's actually one of the, so what we did with our parent loan, we have an option where the parent can specify up to $2,500 that they can have deposited directly into their bank account, because then you don't have to wait. Since it's strictly the parent borrowing, they're the only one responsible for it anyway, then they can take control of that portion of the money that they might need for laptops, books, or living off campus.
Wow, that's a great feature. That's good. And is there, any advantage or disadvantage? Should somebody say, oh, I'm only going to apply for the loan for the amount I need for, fall semester, and then I'll apply again for the second semester, or it really doesn't matter and they should do it once to make it as easy as possible?
So my advice would be, so first of all, this is going to be the classic answer. It depends. I would say it probably depends most on, are you really confident in what you're going to need for the full year? Because you can always go back and try to borrow a little bit more. But if you really don't know what you need for that upcoming spring semester, you may be better off to just take care of fall and then come back for spring. I think the other component I would think about is, where do you think we are with interest rates? And I know this is a challenging question, but because they're really based on what's happening in the market, but it really becomes a question of, do you think interest rates are likely to increase or decrease between now and when you might need that money next? So it requires a bit of research, because again, that there's not a set answer for that. That answer is going to be dependent on where we are in time. But that's what I would consider is, do I think I might be able to get a better interest rate if I wait?
Okay, that's interesting. That's a very good point. Might be a lot for people to absorb, but at least they.
It probably depends on your comfort level, quite frankly.
Right.
You're probably talking about a narrow window of time, so you may not be expecting dramatic changes, but it probably depends on your comfort level with understanding and consuming that kind of information. But it is a consideration if you're really trying to make that decision.
So maybe explain to people, now we've kind of gotten approved, gotten verification, the money's being dispersed. When does the interest start to accumulate? And particularly if you have been approved for a full year, but it's being dispersed in different amounts, when do people need to know that the interest is going to, start?
Yes.
Yeah.
So I'm going to answer that for the private loan. This would apply for the unsubsidized loan as well, just to clarify what I'm answering here. So the interest would start accruing from the day that the money is dispersed to the school. So if you get approved in July, you're not paying interest between, let's say, July and September, maybe, when the school asks for the money. You start paying interest once the school actually has the loan, and essentially, I would say your student is benefiting from the loan. And that is actually part of the reason that they will split the disbursement of the money. If you're borrowing for a full year and you don't need all of it in fall and you don't need half of it until the spring, that's why we only send half of it in the fall, because then you're only paying interest on the portion that you're using. So if you borrow for both semesters, but only half of it goes in the fall, you're going to start accumulating interest once the loan is gone to the school and the money is at the school. And then you're only going to be charged interest on the amount that has actually gone to the school. And then once the second half goes in, let's say, January, then you would start being charged interest on that full amount.
Okay, so there's being charged interest, and then when do parents or students need to start paying back?
So I will tell you that we strongly encourage people to start paying as much as they can, as soon as they can, because it's the way that you're going to control the cost of the loan and save as much money as possible over the life of the loan. Sometimes that's not possible, and sometimes people choose to defer the loans and not make any payments on the loans until they're completely out of school. So let's say you're a freshman and you wait for 4 or 5 years to start making any payments. That's certainly common in the federal loan program. In some of the private loans like ours, we actually give you options up front where we'll put you on a payment plan that you're paying the interest as you go, or you're paying a portion of the interest as you go. So it really is dependent on the lender and dependent on the program, what they will make easy for you to set up. Let me say it that way. Mm-hmm. But really, if you want to begin paying the interest, even on a federal loan, you can do that. You just need to reach out to the servicer, find out what's, generally what's being charged on a monthly basis. And you have to put a little more effort into being the one that proactively goes and determines what you need to pay and to whom. But you can certainly do that if you don't want to accrue that interest through school.
So
but
what
again,
are the different repayment options that College Ave, offers people?
So we have 4 different repayment options. We do offer deferred. So if people need to wait until they leave school to commit to payments, they have that option. We have a flat pay product. So you commit to $25 payments each month while you're in school, and then you start making your full payments once you're done school. We have an interest only. So you're paying the interest charges each month during school. And again, full payments after. And then we also have what we call our principal and interest option. And that's where you would go into full payment immediately. So you're immediately paying against both the interest and the principal on the loan from day one. In many cases with the interest only and the principal and interest option, the two that tend to have maybe the higher in-school payment amounts, we will see that parents often, they co-sign the loan, they make those payments during school, and then the student is able to take over the payments once they leave school. And that's a way where they're sharing responsibility. They're also sharing the repayment, but it works for them and it saves money over the life of the loan.
Mm-hmm. And so when do you make that decision about what choice,
Mm-hmm.
and can you change that? And does making one of those choices of how you're going to pay back the loan affect the interest rate?
Yes. So we do ask you to make that choice at the time of application. So as you go through the application process, once you're approved, you would be presented with your options, and really in sort of a calculator format. So you can see, if I pick this, what will it cost me monthly and what will it cost me over the life of the loan, so that you can make an educated decision. And so you would make that choice initially at the time of application. Now, if for some reason people get into it and they are experiencing difficulty making payments, we always encourage people to call us. Honestly, it doesn't happen that frequently, but if they are having trouble, they can call us and we'll certainly work with them to try to find the right solution. If they've made that choice and it's maybe not working for them for some reason. Remind me what your last question was.
Does it affect the interest rate?
Wow. Thank you. I knew there was a third. It does. So we feel really strongly about trying to encourage people to make these choices that we know are probably going to help them in the long run. And so we do offer lower interest rates for those different options. So if you're committing to making in-school payments, you're going to get a lower interest rate than if you're choosing to defer the loan.
And can you change that at any point? So I would imagine if I chose to defer the loan, but then I decide I want to pay interest, I could start paying interest, even though I might have chosen to defer it.
That's right. You absolutely can. And we do monthly statements the entire time to the cosigner and to the student while they're in school. So it would be very easy to see what is the amount that I would need to pay if I do want to start doing that. And sometimes what we see with people is that they choose deferred because they don't want to commit to a monthly payment.
Right.
But then they make payments if and when they can. And that's absolutely okay too. And we would strongly encourage that too.
Right. That's why I bring it up. That's what I would anticipate, that people are a little nervous. I'm not sure what I can handle. But then as things start, they're like, oh, I can actually pay this off. So.
That's right. Or the $25 a month option is another great option. I mean, and you will save money doing that. And it also, I think, is a great tool for students because it gets them into the habit of making the monthly payment, which I think, there's something to be said for just sort of remembering I have this obligation and getting into the mode of making those payments. And most people can, even most students, a lot of times we find can find the $25. Mm-hmm. So that's a great in-between option too. And then if they can pay more, great, but all they're committed to doing is $25.
Right. Okay. One last section, and then I'm going to go to people's questions. How do any of these loans affect the student's credit or the parent's credit?
So any loan, and this applies to the federal loan, it will show up on the credit report. This applies to federal and private, sorry. It will show up on the credit report of the individual that's responsible for it. So let's take private loans that are co-signed. It's going to appear on the credit report of both the student and the cosigner. Both people will be responsible for it. It will show on their credit reports. And it can be a good or a negative, depending on how you repay the loan. So if you're making, payments on time, then it's going to help the credit of both individuals. So it can actually help build the credit of the student as long as you're repaying the loan. But then you do have to remember, I think as a cosigner in particular, that if you're relying on the student to make the payments, that if they're not making the payments, that could have a negative effect on you. So I think you want to really be aware of it. What are you signing up for? What are the potential positives and negatives? And then you want to have a candid conversation with the student that you're sharing this responsibility with, so that they also understand, if you've agreed that they're responsible for something, what does it mean if they don't do it? So I think everybody needs to understand it. Everybody needs to be on the same page with it. And, ultimately it can be a positive thing for both, as long as the payments are being made on the loan.
Right. And I guess it is something to think about if you're a parent and you've got multiple kids, and depending on how close they are in age and if they're going to overlap at college, you might end up, and if you end up co-signing, you might have a lot of the loans from your multiple kids on your credit. And I guess what I'm saying is actually, the younger child, you may not have as much flexibility in what you can help with.
That's true. That is one of those places I think we see if you are in a situation where you maybe have two parents, that is one of the situations where we will see, maybe mom cosigns for the first two and dad cosigns for the second two, or something to that effect. But I think the really important thing there is that it definitely takes planning. It takes thoughtful planning, particularly if you have multiple kids in the household, to think about what's that going to mean and how are we going to make that work.
And that's why I actually bring it up, because a lot of people are just thinking about the first year. Even if you had one child, you just think about the first year. And even for one child, you should think about 4 years. And now add on, if you've got a second child that might be coming up pretty quickly, you should really think that far, about how much you might have to borrow. And, as you said, who potentially might be the cosigner, and who's going to have the credit or the capacity to, continue to cosign on those loans.
That's right. I know. I think it's probably one of those things that it feels overwhelming in the moment, but if you just break it down into pieces, you will be better at the end of the day if you think about it from that holistic perspective of how many kids do I think I have to get through school, in what window, what does my credit look like, do I have another support here, and try to have a plan as much as you can for multiple years, and if you need to, multiple children.
And are there any limitations on who can be a cosigner?
They just have to meet the credit eligibility. So they would need to be able to pass. They would need to have sufficient credit, the sufficient income, but there's no rules in terms of it has to be a parent that cosigns a loan, or it has to be a relative, nothing along that line.
Right. I bring that up because some people do consider grandparents.
That's true. That's absolutely true. We do see that. I will actually point out, while we're having that discussion, is that is one limitation of the Parent Plus loan in the federal program, is that you do actually need to be a parent, or you need to be legally responsible for the individual. So it is typically a parent. And that is a constraint on that program. Okay.
I'm going to go to questions. I'm going to start kind of towards the beginning of some of the questions that people asked, and I'll, move forward. So Sue asked, here it is. Yep. Sue said, if a student declines to take the unsubsidized loan in August, so like at the beginning of the year, but then they change their mind in January, can they go back and get it then? Can they get just for the half of the year? Can they get the full amount?
So I'm going to tell you that I think your best option there would be to ask the school. I believe that there are definitely situations where you can do that. You can access it in the second half of the year. But I think your best option would be to discuss that with the financial aid office and make sure you're clear on whether or not you'll be able to access it and what the amount will be, because it will probably depend on what your unmet needs are in that semester. So I think your best option in that case is definitely to talk to the financial aid office.
Okay, right. So that goes back to what we said earlier. Don't be afraid to call them up. Don't be afraid to ask questions. You can even ask that question now, because maybe you're going to decide to forego taking the loan now. But before you do that, you want to know, if I need it, can I get it, in January? And they're going to understand your individual situation much better. I think that's the point, is you want to talk to them about what you think your situation is going to be, what you think your costs are going to be in that semester, and what you think you're going to need to cover. And then you can have a very specific conversation with them to make sure that you get that answer that you need. Right. Okay. So I'm just going to repeat Jamie's question, but we really answered it. Asking, can I start paying on unsubsidized interest for my student while they are in college to help them have a little less debt later? Absolutely. You can do that with the federal loans, and you can do that with the private loans. And as Angela said, the more you can do from the beginning in terms of paying off, the better you're going to be.
And you can find out your servicer on your federal loans. So you can go to studentaid.ed.gov. I believe it's /login. And you can actually log in there to get information about your servicers. Or if for any reason you're having trouble logging in there, the other thing I would say is you can pull your credit report. And usually the servicers are going to be listed on your credit report. And that is an easy way to then find out who you need to call to get that information about, roughly what should I be paying in order to make sure I'm covering the interest.
And, we didn't actually talk about it, but maybe you could talk a tiny bit about, like, when you say the servicer, I'm not sure people really even may not understand what that means.
So you're going to usually hear that more, I would say, from the federal program, although it certainly exists in the private space as well. But if you think about the federal program, it's the federal government who is making these loans. So they're lending these loans. And then they have a variety of companies that they contract to provide the servicing. So to send these statements out, to provide a website for you, to answer phone calls. So for the federal loans in particular, you may find that who you need to call is not always going to be the same. So you need to figure out who is servicing your loan on behalf of the federal program. For private loans, it's I would say, it's usually pretty obvious from that provider who is going to be servicing your loan. So, with College Ave, you could come to our website and you're going to see all of our contact information and know exactly who you need to reach out to for information on the loan. So it's usually the federal program where that tends to come up.
Michelle is asking, can you be denied the Parent Plus loan? And if you are denied, what happens?
So you can, as I mentioned, they will look for certain things, like defaulting on a prior federal loan is probably a good example that everybody can kind of understand. If you had a federal loan before and you weren't able to pay it, that might be a reason why they decline a plus loan. If that happens, though, the student is actually eligible to borrow additional money through the direct program. I don't know those exact loan amounts. I would encourage you to go to the federal website for details.
$4,000 and $5,000. So it's a little extra. It may not be enough.
That's right. But they actually do become eligible. So that frankly may be one consideration if you're not sure. You may want to do that in order to get the student access to the money if you need to.
Aparna is asking, what are the negative aspects of co-signing a loan?
Mm-hmm. I think it comes down to you are taking responsibility for the debt is really what it comes down to. So that may not be a negative for you, but you have to understand that legally you're responsible for that loan in the same way that the student is. So if for some reason the student is not able to make those payments, then you are going to be responsible to repay them. So, and it will appear on your credit report. And so, it will be factored into your credit score. And it's really that obligation, and whether or not that obligation is something that you feel comfortable taking on, that is what could or couldn't be a negative.
Right. Yeah, I wouldn't necessarily, I don't think of it as a negative. I just think you need to understand all the potential implications.
Exactly. It's not right for everyone.
Right. Anna has a great question. Like, we kind of take this for granted, but this is what she's asking. Do I need to go to a physical place to apply for the loan, or how do I apply?
So I can tell you with us, it's all online. We do have customer service agents if for any reason you have questions and you feel better talking to somebody, but you can actually do all of it online. Many of the other private lenders are the same. So you can probably do all of this at home, in your pajamas.
Nobody has to see you. Okay, Valencia is asking, and this is good question, I guess, as you get multiple loans and, particularly maybe if you go have loans through the same lender for your student's freshman year and sophomore year, mm-hmm. Do they calculate, is each loan payment calculated separately, or do you get kind of like a combined bill?
That's a great question. So they are calculated separately at the point in time where you're applying for that next loan and you're taking it out. But at least at College Ave, we do combine them into one bill. So you're going to see them all on one statement, and you can see what is due on an individual loan basis, but then you can also see what your total payment is. So you have and if you use the online website, you sort of have choices and options. You could make a payment to just one of your loans, or you can make your payment to all of your loans. So we do try to combine that and make that a little bit easier once you get into servicing and you can see it combined.
Yeah. No, because that's where things, that's where things become like a headache. Not a headache, but like a little bit, you start ending up with multiple loans, multiple payments, and it just gets confusing.
It can, and especially you think, people probably took the direct loan first, so they have an individual federal loan by year, and then you may have that incremental private loan each year. So, find the organization method that works for you so that you have some record of them. But at the same time, yes, there are things that, again, like our combined billing that, hopefully you're getting that are helping to simplify that. That might also be where refinancing can come into play. One of the reasons that people do that is either to lower their interest rate, or also sometimes just to kind of take that noise away, exactly, and simplify and get down to one payment to one provider.
Mm-hmm. Okay, and Andrea has another very interesting question. She said, what happens if I take the loan and my child gets a scholarship, unexpected, maybe sometime in the middle of the year?
Mm-hmm. So I think, one of two things can happen, and some of it will just depend on timing of when that happens. But in some instances, let's say they get a scholarship, and let's say it's actually through the school. The school will refund us the money in some cases, and they'll put it directly back and we'll take it off of your loan. In other cases, just depending on kind of where you are in the school year list, so let's say you're sort of all the way through, then that might not be as automatic. And I would, say you probably need to talk to the school at that point. But most of the time when those things happen, it's relatively early in the school year, and we will often see the school just refund the loan money to us.
Mm. These are great questions. This is, it's interesting to see what people are, don't understand or what they're concerned about. So I appreciate everybody asking these questions, because it just gives me insight into kind of what you're concerned about. So Denise is asking, do schools only work with certain banks?
So I'm going to generalize here and say that most schools will work with any of the private student lenders or the federal program. So most of them will not limit you. I don't want to say none, because it could be a school decision, but for the most part, no, you're not going to be limited.
But do you maybe want to explain, because I think what sometimes might be confusing, maybe this is where Denise's question is coming from. The schools sometimes put out a preferred provider list. Mm-hmm.
So they do in some cases. Again, every school is going to be different. Not every school does make a preferred lender list. Even for the ones that do, though, you are not necessarily restricted to the lenders that are on that list. It's a list maybe of people that they have vetted. It doesn't mean that they dislike the people that are not on the list. It may just be that they frankly didn't vet the ones that aren't on the list. So you are typically not limited to the lenders that are on that list. It can be a great place to start, but you should definitely shop around if you don't feel like they're the right fit for you. And again, I would say, if you have any qualms or questions about it, you can always ask the financial aid office to confirm. But by and large, you are not limited to that list if for some reason you don't feel like that list is the right fit for you.
Amanda is asking again about repaying, but she's wondering if you can pay more than interest, can you start repaying back principal, like here and there on extra payments, like if you have an extra 1 month?
Absolutely. You can absolutely do that. I would recommend that you look at the loan, look at the provider, make sure you understand how payments get allocated. But yes, you can absolutely do that. And I would strongly encourage you to, if you can, if and when you can, make a payment on the loan. Usually the payments will be allocated to any fees or outstanding interest that you have, but then from there you will be paying down principal.
Carol is asking about how soon is it likely that a parent can be removed as a cosigner?
It is very much a case-by-case basis. I will tell you that for us, we do require that you're halfway through the repayment period and that the student can demonstrate certain things, like they don't have a negative credit history for the prior 2 years, payments have been made on time, and they have income that, again, evidences that they're going to be able to repay the loan. So we've set out a very clear set of guidelines for when we will grant a cosigner release. It's lender by lender, so you may or may not find a clear definition. I would strongly encourage you to research it lender by lender and to ask the question of what criteria would we need to meet and how would it be decided if I requested it. Some lenders don't offer it at all. So that is also an important thing to understand. If that's an important attribute to you, make sure you know whether or not the lender offers it.
I emphasize that a ton of times because people just don't realize that they need to actually check that. As you mentioned, check if the lender is offering cosigner release, and then what's your student going to have to? What requirements are they going to have?
How do I get there?
Yeah, I mean, you want to know that now. You don't want to be surprised later.
That's right. That's right.
So Tori's asking that they have. Oh, she even put up a picture of two kids graduating at the same time, a week apart. Does it hinder if one? Basically, does the age of a student matter when applying for a private student loan?
The age is not taken into consideration at all. Age can come into account. Age can affect whether or not you're likely to have a credit history. Obviously, somebody who's older, it may be more likely to have a credit history. But age in and of itself is absolutely not considered.
Okay, Alex is asking, and this might be good to clarify. He's saying, I heard that the interest rates are set July 1st. So should I wait to apply for the loan until after the date to potentially get a better rate?
So July 1st is the date that the new rates for the federal loans go into effect. But they actually go into effect on July 1st for any loans that are dispersed after that date, which means that the money goes out the door to the school after that date. So you don't necessarily need to wait until that date in order to accept those loans. So that would be your federal direct unsubsidized, your plus, any of those. Essentially at this point in time, if you're borrowing for the fall or you're borrowing for fall and spring, the money will go out after July 1st. So you're already going to benefit from those rates. And for private lenders, by the way, the rates are not reset on July 1st, at least it's not a general rule for those on the way that it is for the federal program. So I would not assume that you're going to see a change in rates on the private side for July. That would really be a federal piece.
Right. The July 1st really relates to federal interest rates, but will interest rates for private lenders change over the next few months? I mean, or the rates that people are seeing now, can they, if they just don't apply until June or July, are those going to be the rates? I just want people to know kind of, that may or may not be changing.
They can change, and they could change based on the external market. So essentially, the external indices that we use to decide what is the right interest rate to charge based on the market. So you may see them change. I would not expect for you to see dramatic fluctuations personally. But yes, they absolutely can change over time.
Right. I only say that because, again, they might see something listed now and they may not actually go to apply until the end of July. And
it could be different. It could be different.
I can't imagine they're going to be dramatic, but it could be, 5.15 now. It could be 5.35. You know what I mean? There could be change. So you can't, just because you see it now does not mean when you go to apply, that's going to be the interest rate available.
That's right. That's right.
And actually, one thing we did not talk about is maybe you could, that there are two sets of interest rates usually shown, fixed and variable.
Sure. Yes. So all the federal programs are going to be fixed rate only. And then on the private side, what you will typically see is a choice of either a fixed or a variable rate. So the fixed rate is going to stay the same for the life of the loan. It's not going to fluctuate once you lock that rate in. That's the interest rate you're paying. A variable rate goes up and down over time. It's based on, the market rate that I mentioned. We use LIBOR, so it will fluctuate up and down. And what you will typically find is that the variable rate that you're offered at any given point in time is usually lower than the fixed rate that you could get at that same point in time. So the choice you're essentially making is, how much do I think that rates are going to change over time? Would I rather have the consistency that I know what my fixed rate is going to be, or would I rather take the variable rate that might be lower at that point and trust that I don't think it's going to increase that significantly over fixed. So that's again where I say, similar to what I mentioned before, I think it depends on kind of your comfort level, what makes sense for you, what you are comfortable with. Because if you take a variable rate, as the variable rate increases or decreases, it will also affect your monthly payment. So if the interest rate increases, your monthly payment will increase. If it decreases, it will decrease.
Right.
And so you may see fluctuations in your monthly payment. And that is sometimes also why people like the fixed rate, because they know what they're getting.
It's harder to predict, if you're trying to create a budget and, things like that. You just, if you take the variable, it may end up being positive for you, but it also may go the other way and you're not going to know.
It is. And I think it's a personal comfort level decision from that standpoint, but yes.
So Alex is asking, do you have any recommendation, and you may or may not, and that's fine, about how many banks somebody should potentially apply to kind of see, what the varying interest rates are that they get back?
Well, I would say first and foremost, I would say pre-qualify anywhere you can.
I agree.
So you're not affecting your credit score.
Uh-huh.
And then in terms of how many to shop, I honestly think that is a personal decision. In terms of how many offers you feel comfortable comparing, I honestly don't have a specific recommendation. I think it really comes down to how much time do you want to spend in the process and how many do you feel like you need to get comfortable with what you're comparing.
But that's a great suggestion. If a lender's offering pre-qualification, do it. There's absolutely no harm, and you're going to get information. That's that's valuable for your decision. Okay, so Nellie is asking about employment history and income of the parent. I guess one thing and how much does that affect the decision of the lender? Not that you have to go into detail, but can you give it just a high level of some of the things that lenders do look at to make a decision?
Mm-hmm. So every lender is going to be different. Everyone's going to have their own processes. I would say some of the most common things that people will consider, they're going to consider income, but they're probably not going to consider income in a vacuum. They're going to think about what we call debt to income in many cases. So what's the income that you're bringing in and how does that compare to what your debts are? Because if you have a very high income, but you also have very high debt, then that's not necessarily better than having a low income with no debt. So they don't think about income in a vacuum. It really is in the context of what else you're also paying. And then they're also going to look at really your history. So, how many, I feel like this is going to be jargon. How many trades do you have? And really what that means is how many lines do you have on your credit report, and are they all the same thing? So do you have only credit cards, or do you also have a history of a mortgage and a credit card and an auto loan, and you have a positive repayment history on all of those things? So it is multifaceted, and they're really going to try to take into account what does your whole credit picture tell them in terms of, are you likely to be able to repay this, and are you likely to do that?
But just going back to the beginning of your comment, every lender is different. And that goes back to the discussion we had earlier where people say, well, what's the best lender? Where should I go? You can't give a straight answer for that. You got to go through the process, and you got to do your research.
That's right.
So Denise is asking, and you may not know this answer. I have an estimate, but I'll ask anyhow. What rate? Basically, when you add on the origination fee for Parent Plus loan, like what is that? What's the equivalent interest rate that might come to? So you have the little over 7% of the interest rate, then you have a 4.2 something percent origination fee. What does that really equal if I combine the two?
So let's see if we have roughly the same estimate, because it's been a while since I looked at this. But I thought the last time I looked at it, it essentially say it would increase the interest rate from like 7% to basically 8%.
That's exactly what I was going to say. Yep. That's kind of like a very good one. Yep. So that's important to know. I mean, that's why it's so important to understand that origination fee.
Mm-hmm.
You look at the Parent Plus loan and it says, 7 point, something percent. Mm-hmm. But that origination fee is a chunk, and that basically adds 1 basis point, which is a lot.
That's right. That's exactly right. And I think it, particularly depending on how much you need to borrow. So if you're borrowing a smaller loan amount, it may not be as big of an impact for you because it's a percentage of the loan amount. But if you're taking out a larger loan and you're you're paying 4% of that loan as a fee, that's significant.
Okay, the question was, which we answered, but I'm gonna repeat it. Does every lender have pre-qualification? No, they do not. College Ave definitely does. We'll put the link in there. But take advantage of the pre-qualification. Just cannot hurt. To me, it's like, if you like gathering information, which you should in this process, it's just, it's kind of like free information that you should have for your decision.
I completely agree. And I will just add too that we also have calculators available on there. So if you want to look at what some of these options, we talked about paying $25 a month or paying the interest. We have calculators to help you understand what that will really mean monthly and what it will mean in total. And it might be valuable for you as a parent. It might also be valuable for you to show your children who are thinking about taking on these loans as well, so that they can understand what it means and why, if you can find $25 a month, why it makes a difference.
So Valencia is asking, is it wise to pay a portion of the tuition and then take a Parent Plus loan for the remainder, or should everything go on the Parent Plus loan? I would say it's a personal decision, but maybe you have a little bit of guidance. I don't think there's a one answer to that.
I mean, I definitely think it's a personal situation decision. That's something it's really difficult to answer without knowing the full context of your finances and where the child is in school and all of those things. So I would say, if you have questions like that, though, find a financial advisor or talk to the financial aid office, talk to somebody who can go in depth with you on your situation and help you find the right path forward, because everyone is unique.
Right. Okay. Wow. So we had great viewership, great questions, everybody. And we're almost coming on to an hour and 15 minutes. Before we finish up, and Angela, we were talking about this before we even started the Facebook Live. I love what you told me about College Ave and the focus on parents. And I just think that would be important for, people who are listening to hear this, because honestly, that's kind of why I started what I'm doing. It's to really help parents. So it was nice to hear that was, behind a lot of, what got College Ave started.
I feel like I've seen a shift every year I've been in this business, that I've seen parents get more and more and more involved. And I think that's a great thing. And we really feel like, in many ways, the parent is the best support system for the child and the student. And so in many ways, what we're here to do is help support the parent, so that by extension, they can help the student make good decisions. So that's a big focus of what we do, is to try to support parents in making these choices, understanding, as they're making these choices, what they're committing to, what the student is committing to. And then again, by extension, being able to pass that on and feel confident that they're giving their student and their child, the right information to get off on the right foot financially.
And as you mentioned to me earlier, by focusing on the parent, that's why you have the pre-qualification, when other lenders might not have that, because that's important for the parents.
Yes.
I love the idea that you combine the payment amounts. That makes it easier. Most likely the parent's going to be looking at that.
It's interesting that we got that question. I have to say, that's not a question I usually get. It's a great one. It actually made me think, I don't know if we tell anybody that, because it's not a question we get very often. So it's, that was useful for me.
Yeah, I never thought about it. I never had anybody ask. I wouldn't have even thought myself to even ask a lender if they do that.
That's right. It's a great question. We'll improve our FAQs from that.
Okay, one last question. Oop, it just slipped by here. If there's money left over from one year, is it better to pay off or to use it for the next year? Not sure if I'm completely understanding that question. Maybe if you can give us a little bit clarification, but I thought maybe what they were going to was with this question that sometimes people ask, is if I have savings, should I use it all at once? Or should I think about paying it over 4 years? A lot of times, again, this goes back to like people being focused on just the first year.
Right.
You should really take your savings and look it over multiple years.
Yeah, so here's what I'll say. Unfortunately, I'm going to tell you again, it depends on your personal situation, but I'll tell you what I think you should probably be considering there. I think you're going to want to weigh, if you take that loan out, let's say you take it out freshman year, instead of using your savings, unless it's a subsidized loan, you're getting charged interest from day one on that. Versus if you use your savings and then you wait to borrow, you're not getting charged interest. However, the counter of that is that if you're really trying to rely heavily on the federal program and you're trying to only stay within the federal program in the student's name, you do have those annual caps. So if you don't borrow the $5,500 freshman year, it doesn't mean you can take that $5,500 and add it to the sophomore year. You can still only take $6,500. So it's a personal decision, but those are the things I would weigh. How long do I want to have the loan? Does it make sense to be accruing the interest on that loan? But then also, what will my funding options be sophomore, junior, senior year, so that you can make the right end decision? There's not one right answer, unfortunately.
Right. I mean, I think is a good way to end. In some ways, we gave a lot of good, general information, even a little bit more specific information, but everybody's situation is still unique. So you should take this information and kind of see how it applies to your situation.
Absolutely.
And I will just also kind of reiterate, Lynn is asking, is this Facebook Live available for replay? Absolutely. All the Facebook Lives are recorded. Just in case you can't, it's on the Road to College Facebook page. There's a tab that says live videos, but I will kind of post it again here. And that's actually the beauty of these Facebook Lives. You might have watched it tonight, but maybe you want to show it to your spouse. Maybe you want to show it to your student. Maybe you want to replay it to because you didn't catch everything. So it's recorded. Come back and watch it. Well, thank you, Angela. This was great.
Thank you. I appreciate all the questions. I think that this was fantastic, and I hope it helped.
Yes, it definitely helped. Thank you, parents. The questions are they're great. I mean, we want to help you. The only way to help you is if you ask the questions, and now we know more of what some of the issues are. And thank you, College Ave Student Loans, and we're going to have a lot more coming from them in the future. Okay, bye. Thanks again.